Welcome to the Chapter 8 videos. This chapter is all about cost recovery, which we think of as depreciation, amortization, and depletion. So cost recovery for tax purposes is unlike book purposes in that it is largely prescribed, meaning there's not a lot of room for estimate like there is in book accounting. So for tax purposes, assets have fixed recovery periods. You use specific methods to depreciate, and you generally just can't waver from those methods. And so, I find that students struggle with this, not because it's difficult, because it's like so many things in tax, rules driven, and the rules are not always intuitive and easy to follow. So, my suggestion on this chapter is, try to pay attention to the rules and do the calculations as mundane as they feel and help yourself try to struggle through. Okay, let's keep going. All right, so we start with this notion of capitalize versus deduct, and I think I introduced this in class a little bit previously already. So we know that businesses need to capitalize the cost of assets with a useful life of more than 1 year, and you put those on the balance sheet as opposed to expense them. And this arose when we talked about cash basis taxpayers not being able to deduct it when it's paid, right? So if it has a life that extends beyond the end of the tax year, in theory, you're supposed to capitalize that cost. So when you capitalize cost, it's not as if in most instances you don't recover the cost, you simply recover it through an artificial means of recovery. It's not that it's losing its value necessarily. It's not that this matches the economic decrease or its usefulness. This simply represents an artificial way to recover costs. And the idea is it presents some degree of matching against the revenues derived from the asset. So we call it, as I mentioned, depreciation, amortization, or depletion. And that depends on the underlying nature of the asset. Depreciation, we generally associate with real or personal property, amortization with intangible property, and depletion with natural resources. So just to be clear, deduct means to, basically put it through expense. It goes through your income statement. And it's recognized, therefore it has no life, right? You expend money and that money is gone. Whatever you needed it for, you expense away. That's different than capitalize, right? Which is now I've expended, funds or something. I've expended assets of some sort on something. What I get in exchange? I got more assets. And so, I spend cash on something. It has a life. It's probably recoverable, and so I put it on my balance sheet. And this doesn't just go for plant, property, and equipment. Inventory works the same way, right? I purchase inventory. Where does it go? It goes on my balance sheet until such time as I sell it. So how do you recover the cost of inventory? Well, you do it by selling it. So lots of things get capitalized. We've really talked about those, but the common thread is they land on the balance sheet first and then find their way to the income statement. So what are the tax rules on this? Well, we've got a couple code sections. The first is 162, and this is the ordinary necessary business expense deduction. And we've really covered that. The new one that we haven't really spent a lot of time on is 263, and the reason we're not going to spend a lot of time on it is it doesn't tell us much. So it says no deduction shall be allowed for any amount paid for a new building. Okay, so buildings, that makes sense. Permanent improvements or betterments. Okay, I kind of get improvements. Not sure what a betterment is. It sounds like a cookie or something. That are made to increase the value of any property or estate. And so that really is all the code gives us. It gives us very little guidance with respect to what it is we're supposed to capitalize and when. And so we always default back to this same kind of principle. Well, if it's going to last beyond the end of the year, we should capitalize it. But there's a huge difference in the outcome, the result of capitalizing something and depreciating it over time and just deducting it. And of course, taxpayers vastly prefer a deduction to a depreciation because it comes so much quicker, right? You save tax money far more quickly than you do under a depreciation or amortization system. So in any event, what's happened is the IRS has issued regulations to try to help taxpayers understand what's meant by these terms. And Congress has not weighed in centuries, and so the likelihood of them coming along and rewriting the code to really prescribe this choice is low. And so the IRS has issued regs multiple times. I think the most recent version is going to stick finally. I think maybe they got it reasonably right for a change. Okay, so more specifically, the rule is anything that's a betterment, an adaptation, and a restoration needs to be capitalized. So this is what the regulations tell us. Now, again, not the code, but the regs. So what's a betterment? A betterment is an amount paid to fix a material condition or a defect that existed prior to acquisition, or that arose while the property was created. And what that means is it arose when you were constructing it or building it. So we don't always buy our assets. We sometimes create them as well. So expenditures for material additions, including enlargements, extensions, the addition of a major component, these are generally treated as a betterment. Expenditures that are expected to increase the productivity, efficiency, strength, quality, or output of property are considered a betterment. An adaptation is an expenditure that allows the property to be used in a new or different use. And a restoration is the replacement of a major component, a substantial structural part, or combination of parts that make up a substantial component of the property. So you can see there is some overlap between these three. I mean, and I don't believe that they're intended to be discrete items necessarily. Can you have a betterment that feels like a restoration? I think absolutely. So, but at least we have some guidance to roll with. So restoration also includes amounts paid to return property to its normal operating condition if that property is deteriorated and is no longer functional for its intended use. So this is not, making an oil change to your car. That's fairly modest repair, and I would say that doesn't imply that it's not in its normal operating condition. This would be more like you're, getting a junker car out of the junkyard somewhere and trying to repair it. Amounts paid to rebuild property to return it to a like-new condition after the end of its useful life. These are also considered a restoration. So imagine, if you will, you've got a machine, for lack of a better term, and the machine is worn out. It's done, right? And so you're like, okay, we got two choices. We can either kind of fix the old one, right? Get it back to functional again, or we could buy a new one. Clearly, if you buy a new one, you would need to capitalize that cost, right? I mean, that's buying a new piece of long-lived equipment. And I think that rule is designed to kind of capture the idea of, well, maybe instead of buying a new one, we're just going to spend a bunch of money and rebuild what we have. And the outcome shouldn't be different. I think the way the IRS wrote the law is like, hey, under either of these circumstances, you should have to capitalize those costs. The last one is expenditures to replace property for which a gain or loss and associated basis adjustment have been taken. Those are considered restorations. Well, I didn't get very far into this one before I started yawning, although it's 8 minutes and what I'm on slide 5, so you guys are probably yawning too. Let's get going. Costs to be capitalized include all costs to get the item ready for its intended purpose. So this is when you purchase something, the freight, the installation, the sales taxes, the delivery, the testing, anything to get it ready so you can use it. Those costs are capitalized along with the actual kind of purchase costs of the item itself. There are two safe harbors around restorations largely. And this has to do with, hey, look, I appreciate this. It's really hard for me to determine whether when I do a basic repair, if I'm supposed to capitalize that repair then over the useful life of the item, or am I allowed to just deduct repairs and maintenance? Because typically you can deduct repairs and maintenance. And in fact, there's some regulations in Code Section 162 that cover that. So two safe harbors. The first is called the de minimis safe harbor. And if you have applicable financial statements, if you have a written policy for your books and records, so for book purposes, you write off anything $5,000 or below, either by item or by invoice, you can just deduct that for tax purposes as well. So they will allow you to conform your tax to your book as long as you have a written policy and you actually do it for book purposes as well. If you don't have applicable financial statements, which really are audited financial statements, there's situations where I don't want to get too deep in the weeds, but if you've had agreed upon procedures or the new government, I can't remember what it's called anymore, the Department of Labor, those are considered audited as well. But either way, if you don't have audited financial statements, $2,500 per item or invoice is your cap. You don't have to have a written policy, but you do have to actually institute that policy in your books and records. So it needs to be followed. And the second safe harbor, so that means, you could buy, 60 computers for $1,600 each. And we all know that a computer doesn't last forever, but it probably lasts for more than a year. And rather than depreciate them, you could just deduct them under the de minimis safe harbor as long as you were doing it for book purposes as well. So routine maintenance is the second safe harbor. And this says, okay, if you're performing maintenance on buildings, because there's two different scopes on this one for buildings, one for non-buildings. If you're doing routine maintenance on your buildings, anything that you would expect to undertake more than once every 10 years, you can deduct. So, I like to think of that as like paint and carpet. Especially for high traffic areas, you might have to replace the carpeting more than, once every 10 years. You might not in your house, but you probably would in an office building or a highly trafficked like store, something along those lines. If you would expect to do that more than once every 10 years, you can just deduct it. For non-buildings, if it's expected to be performed, whatever that maintenance task is, more than once during the ADS recovery period. And ADS is just the alternative depreciation system. And that's actually longer lived than the maker's system, which we'll get into in a little bit. So they give you a little bit longer life, but those lives are prescribed, right? You don't get to choose what you think the life is for that one. It just is what it is. And if you would expect to do it more than twice, you can just deduct that cost as a repair. There's also a small business safe harbor. This one's not quite as potent. Gross receipts of $10 million or less, and ownership or lease of buildings valued at $1 million or less. So that's pretty hard in Southern California not because of the $10 million worth of gross receipts necessarily, but you better be in a building that's not worth very much to be $1 million or less in this part of the country. In any event, the reason it's not really valuable is because you can expense items as paid, as long as the amount you pay during the year is not more than the lesser of 2% of the cost of the buildings. So 2% of $1 million, $20,000. So that's not very much, but it doesn't matter, right? Because it's also $10,000, right? So, this is for really, truly small businesses. I can't imagine someone with gross receipts of $10 million not spending more than $10,000 on repair and maintenance type activities. But maybe it's good for a service company that doesn't really have a lot of capital assets to begin with. Okay, there are a handful of places where the code just gives you a deduction where you might not expect it. I don't want to spend too much time on these, but cost to make facilities handicap accessible, intangible drilling costs. It's just, you should be aware that there are a handful of places where the code says, hey, we know normally you'd have to capitalize this, but in this instance, because it's this type of expenditure, we're just going to let you deduct it. All right. So just to be clear, in the world of property from a tax perspective, when it comes to tangible property, which is things you can touch, we've got real property, which is land and all the things that are attached to it, and we've got personal property. Now, personal property isn't personal use property. Personal property is tangible property that isn't real property. So this generally is kind of anything that isn't nailed down, dug into, or built onto the land. So a house is real property. But a dining room set is not real property. Intangible property is property you can't touch, right? So that's not to say that it doesn't exist, like patents, copyrights, prepaids. They're just pieces of paper, right? They're represented by some sort of piece of paper that says you've got some sort of exclusive right to that. So typically the basis of purchase property is the original cost adjusted by those installation related items, which we talked about previously. The basis of real property will also include settlement charges, and these are the charges to establish title, generally speaking, to the property itself in the U.S. When you purchase real property, you almost always have to have some sort of title, and you file paperwork with the county or some government jurisdiction to establish your ownership of that. And those costs are capitalized. Those aren't just, you can't just deduct those as like professional fees. They become part of the cost of the land or the building or whatever it might be. For things you construct or build, they have these rules called uniform capitalization. That extends beyond the scope of this class. Being aware that UNICAP exists is pretty important. But unless, a few years down the road, you become associated with a company that has a lot of inventory, you're unlikely to fall prey to having to understand UNICAP in all that much detail. But it's basically a prescribed system for what costs need to be capitalized into inventory. Okay. So we talked about the different methods, right? Depreciation for tangible, personal, and real property. Land is a non-wasting asset, so it's never depreciable. Amortizations for intangibles, and depletion is for the cost of natural resources. And we talked about inventory already. Okay, so the basis for cost recovery, once the asset is placed in service, generally speaking, you begin depreciation or amortization or whatever it might be. And we dealt with that, right, with org costs and startup costs. We said we had a full month convention, so the month in which you started business, that's when you started the amortization, and that's considered to be placed in service. So your basis is reduced through cost recovery. That's why we often use the term adjusted basis, because we've adjusted the basis for any element of cost recovery we might have had. So adjusted basis is often its initial cost less accumulated depreciation or accumulated amortization or accumulated completion. So in a pretty obvious example, Bob buys property for $100. There's no depreciation permitted. He sells the property for $80. He's got a $20 loss. But if Bob buys property for $100 and he depreciates it for $20, then sells it for $80, well, then Bob's already taken a $20 deduction for depreciation. So he really shouldn't be able to deduct that additional $20 loss. That would be double counting the decrease in the value of whatever that property is. So he adjusts the basis of the property by the $20 first. And so what that means is his adjusted basis becomes 80. So when he sells it at 80, there's no gain or loss, right? And so that's how kind of cost recovery functions. Again, it feels pretty obvious, but always important to kind of cover it explicitly as well. So how is depreciation done for tax purposes? Well, pre-81, it used to have a system that was pretty much like book accounting. You use a salvage value and you determine useful lives. But in 81, the economy was suffering a little bit. This was right after the Iranian hostage crisis. We were coming out of really high inflation, and so Reagan was elected president. His administration wanted to try to stimulate the economy, and so they created ACCTG, the Accelerated Cost Recovery System. And this really was, not entirely, there were some other predetermined rules around depreciation, but this is where we really got to the point where they were prescribed, and basically there were big tables issued, and it said, hey, if this is the asset you buy, then this is the amount of depreciation you take, and here's the speed at which you take it. And it was accelerated. It was designed to recover things faster than you would have under their previous kind of useful life rules. And then over time, they decided to back off the stimulus. Number one is it was expensive, right? It cost revenue to the government to allow people to deduct those costs right away. And so they've slowed it down and they modified it. So it became the modified accelerated cost recovery system, which because the old one was called ACCTG, it was generally called MACRS. I hear people call it MACRS sometime. I don't even know what MACRS is. But isn't there some sort of scotch or something, MACRS, Mark? Just kidding. Okay. So again, these cost recoveries start when the asset's placed into service, not when it's purchased. For items that are things like large buildings where it might be placed into service at different times, only the portion that is placed into service gets depreciation. So imagine you build a tall building and only the first 3 floors are approved for occupancy. Then what you would do is start depreciating the cost that you'd allocate to those first 3 floors. And the rest of the building that hasn't been approved for occupancy, you would not start depreciating. So an item is considered placed in service when it is ready, available, and capable to perform its intended function. So that doesn't necessarily mean you are using it for its intended function. It simply means it's ready, available, and capable. And so there's no like gaming, if you will, about when you get to start your depreciation. And the rules are pretty strict on this. It's depreciation that's allowed. You have to reduce the basis by. So taxpayers can get in a situation where they forget to depreciate something. But what happens is they still have to adjust their basis. So you've adjusted your basis, but you didn't get to deduct the losses. Now, if, there's a statute of limitations. You can open up to 3 years worth of tax returns and at least get your 3 years worth of deductions if you forget something. Okay, so what is the IRS method of depreciating assets? And it's a 7-step process. And it begins with, admitting that you have a problem. No, I'm kidding. It begins with knowing what system you're going to use. And there's the general depreciation system and the alternate depreciation system. The alternate depreciation system is used rarely. It's actually a slower system. So you will see its use, for example, in biotech and startup industries. So, there are clients in San Diego that use ADS. And it basically depreciates everything on a slower basis and generally on a straight line basis. We're not going to dig in too deep on ADS. Once you get regular depreciation down, you'll see that, ADS is basically just use a different table in a way. Okay, so the next thing you establish is what is that property class. And property classes are defined. There's a big revenue procedure from back in the 80s that basically has a giant table in it that lists, okay, if this is what your asset is, this is its property class. And property class is like recovery period, but not exactly. But you need to know what property class it falls into because obviously that's going to define the depreciation. And you can go to an IRS publication 946, and it has those tables in what I would say an updated fashion. The problem is 946 is always about a year late. So then you establish the date it was placed in service. You determine what the basis amount is. And remember, it's what you paid for plus the cost to get it ready for its use. And then based on that information, you can establish the actual recovery period. And recovery period and property class, not the same. But the recovery period is the life under which you are actually going to depreciate it. But we'll see that even a 5-year recovery period doesn't get recovered over 5 years. Hey, that sounds like tax, doesn't it? Then you determine the convention that you apply. And again, I introduced you to conventions with org costs and startup costs. For depreciation, you use either mid-quarter, mid-month, or half-year. And we'll talk about when each of those goes into play. And then you select the depreciation method. And under GDS, it's almost, for all personal property, it's almost all 200% declining balance or double declining balance. And if you don't remember how to calculate double declining balance, depreciation from your old fundamental financial course, do not sweat it one bit. The IRS is going to provide us with really helper tools to make sure we do that properly. Alternatively, there's 150 double declining balance if you go ADS, and there's straight line, which is used for basically almost all real property. So I have a slightly different method. It's just figure out what the right table is. And so the IRS publishes these tables. And you can use them. And we're going to use 7 tables. It's not to say that there aren't more than 7. There are. But I would say that these 7 tables probably cover 95% of all depreciable assets placed in service, unless you work somewhere like a utility or a gas pipeline or something really unusual. For the most part, everything is depreciated over using one of these tables. The personal property tables tend to be shorter lives. So that's the half-year and mid-quarter convention. So that should tell you right away, for personal property, it's either mid-quarter or half-year convention. That's right. And for real property, what we'll find is it's always the mid-month convention. And real property is broken down into residential, so places people live, and non-residential, which is, of course, places people don't live. And as I mentioned, there are other tables. Okay, so let's do some personal property depreciation. So personal property, again, is tangible property. It's any property other than real property. So computers, automobiles, furniture, fixtures, machinery, equipment, pretty much anything other than real property that's tangible is personal property. Again, not to confuse personal property with personal use property. These are not the same. Personal use property is not even depreciable. So my car is personal property. And because I use it only for a commute and I don't use it for business, it's also personal use property. My house is personal use property as well. But my house is also real property. An office building, right? I sit in Student Services East. That's real property, but it's not personal use property. That's business property and would be depreciable. All right, so we talked about these depreciation methods, the three acceptable versions: double declining balance, 150% declining balance, and straight line. Again, use of ADS and straight line is limited, so we'll focus on double declining balance. So the recovery period, you can see what those are. We talked about establishing what the class life is. So the class life was like for furniture and fixtures down in the table below. The class life is 10. But look, you can see that the general recovery period, which is GDS, right? That's the one we almost always use, is 7 years. So this is that modified accelerated, right? There's still some accelerated versions. But look at the one below that for light general purpose trucks. The class life is 4 years. So in a way, they really only expect it to last 4 years. But notice that the recovery period, both the general and the alternative, which is normally slower, is for 5 years. So in this case, they make you depreciate something for even longer than your actual expected class life. So again, you can find these in Pub 946. You can also find them in RUGPROC 8756, but that's dated back to 87. So to the extent there have been changes, you're not going to see it in that document. They don't update RUGPROCs. So 946 is a good place to go. So common asset lives, if you look for business property, holy cow, these two categories pick up nearly everything. So cars, trucks, computers, peripheral equipment, 5 years. Furniture, fixtures, machinery, and equipment, 7 years. So when you think of personal property, it's not everything you could have in a business, but it's a lot of what you have in a business. So property can be placed in service at any time of year. And so let's say we place something in service on January 17th, machine 1. And if we were trying to depreciate it, we take the cost, we multiply by 200% because it's double declining balance. We divide by 7 and then multiply by 348 divided by 365 days because January 17th must leave 348 days for the rest of the year. If we put something in March, then we would say, oh, okay, well, it's cost times 200% divided by 7 times 281 divided by 365 days. And what we'd find is that counting these days is really inconvenient, and the IRS decided it was so inconvenient. And remember, a lot of these rules were set pre-computer era, that's not the way we're going to do it. We needed a simpler method. And so what they said is, hey, you know what? The rule's going to be for tangible personal property, the rule's half-year depreciation. So we call that the half-year convention. And what it means is no matter when you place it in service during the year, you take a half a year's worth of depreciation for that year. So if I place it in service January, I take half a year's depreciation. In March, half a year, July, half a year, September, half a year, October, half a year. If I placed it in service on December 31st, I'm taking a half a year's worth of depreciation. Well, and that alone created problems because taxpayers would come around to year end and they'd say like, oh, well, I was going to, put this thing in service in January or February. Why don't I go ahead and buy it now and place it in service on the last day of the year? And that way you get a half year's worth of depreciation. And that's really, what all this SpongeBob crap says. So basically the IRS said, hey, this is not what we intended. We don't want people overloading the final quarter of their tax year with purchases of depreciable property in an effort to try to claim half a year's worth of depreciation when it's really only been in service for a day. So they came up with the mid-quarter convention. I had to stop and take a drink. Sorry, guys. So how do you determine if you're a mid-quarter, right? Well, the rule is, hey, are you abusing the half year? So think of it as, okay, well, normally people would put 25% of their equipment in service in each quarter, right? If it were randomly distributed across time, you would expect everyone to put 1/4 of everything they purchased during the year in service during any particular quarter. So they said, all right, well, how do we determine what a deviation from that is? And they said, okay, to the extent I have a lot going in the final quarter, that sounds like I might be abusing. And that's what they said. They're like, look, if you put 40% or more in service in the final quarter of the year, then you have to adopt the mid-quarter convention. And the mid-quarter convention is more complex than the half year. It says, okay, well, that means for whatever quarter you did place it in service, you take half a quarter's depreciation. So again, we're going to sum up the total basis of tangible personal property, not real property, just personal property placed in service during that year. We're going to divide it by the total basis of tangible personal property placed in service only in the fourth quarter. And if that ratio is more than 40%, then you are not permitted to use the half-year convention. You must use the mid-quarter convention. You apply this test once in the year in which you place the personal property in service, and then you stay with that method for every year thereafter. So what that means is it's an annual test, and you could place assets in service in 2021, and based on the timing, you could have mid-quarter convention. But all your assets in 2022, based on the timing, could all be half-year convention. So each asset really may have its own tracking system that it needs to follow. So Jane placed personal property in service as follows, right? So here it is. We got March, April, October. There's her 2021 total. And then in 2022, we have some in February and some in June. So let's do the convention test for 2021. Well, we placed 4,000 in the fourth quarter, right? That's October. Over 4,300 in total for that year. That's greater than 40%. So for the item placed in service in March, the item placed in service in April, and the item placed in service in October of 21, all three of those items would use the mid-quarter convention. Versus the 2022 test, where I have not put anything in service in the fourth quarter. That's less than 40%, so everything gets the half year. And even if I place something in service, now, September, October, that's not the fourth, September's not the fourth quarter. Even if I place something in service in November, as long as it didn't amount to more than 40%, I'd still use the half year convention for that. Okay, so the IRS publishes tables by which we calculate the amount of depreciation. And so that's why I said, look, you don't need to remember how to do double declining balance. I'll show you in a few slides, but you just don't need to remember how to do it because they provide tables. And you would find those tables, guess where? In your table pack. So if you don't have it, you might want to pull your table pack out. All right, so before we go on, I know I clicked forward, but before we get started on this next part, I really do kind of want you to have your table pack. And so we're gonna cut this video here. It's been going 30 minutes. My God, that's plenty of time. And we'll make the next one part 2, and we'll go through a big example of calculating depreciation. So if you remember how to do it, you've had this material in a previous course, you might be able to skip the next video because we are literally just going to calculate depreciation on the items on this slide. See you soon.